Welcome to Blind Spots, a podcast where we're helping you fill the gap between what you want to do with your money and what you actually do. We are professional investors, writers, and financial planners helping you navigate the complexities of finance to optimize what you can control and cut out the rest. Join your host, Nick Shermans and Aaron Varghese, as we discuss the questions and nuances surrounding everyday money management. Investment advisory services offered through Pure Portfolios, a registered investment advisor with the U.S. Securities and Exchange Commission. Nick Shermans and Aaron Varghese work for Pure Portfolios. Any opinions expressed by Nick and Aaron or any podcast guest are solely their own opinions and do not reflect the opinions of Pure Portfolios. This podcast is for informational purposes only and should not be relied upon for investment decisions. It should not be construed as legal or tax advice and is not intended to replace the advice of a qualified attorney or tax professional. Clients of Pure Portfolios may maintain positions in securities discussed in this podcast. This information is not an offer or solicitation to buy or sell securities. The information contained may have been compiled from third-party sources and is believed to be reliable. Hello everyone, and welcome back to another episode of Blind Spots. Today we are going to be talking all about taxes in retirement. And this podcast episode was inspired by a meeting that I had with a client a couple of weeks ago. And this particular client is several years away from retirement, but they asked the question of how are taxes calculated in retirement? And for us, this is something that we talk about all the time. It's a pretty common question and conversation that we have. But this client assumed that there was a look back at the number of working years that they had, maybe average taxes that were paid over those years, and then that determined the tax rate in retirement, which, as many know, is not correct. So this is a confusing time. Retirement is a completely different set of years and experience than what your working years are. So we want to kind of set the record straight, talk about how taxes in retirement are calculated, and just help fill the gaps with answers that you may be also wondering.
So let's be clear here too. One, I think taxes are a joke in this country. So don't feel bad if you're confused, because many people are confused. Your CPA is confused. Your advisor can be confused. And it's a rabbit hole of nonsense and pages upon pages of stuff. You know, I've talked to some of my family members who are over in Europe, and when they explain their tax situation to me, it's very simple. They get a form from the government. There's 3 boxes. You check one of the boxes, you send it back. Unfortunately, the U.S. tax code is the opposite of that. So don't feel bad if you need a good CPA or just some counsel to help you get your taxes together.
Yeah, taxes are complicated for just about everyone. We don't really learn about it in school, and it's constantly changing. That's what is fun about working in this industry, is that there's always something new to learn and something to keep up with, but it's difficult. And if you're not entrenched in it every single day, it's not something that you are going to keep up with and something that you want to keep up with.
So when you were working, your HR person probably gave you a form and said, put a percentage for withholding taxes. That's about as deep as you got on the tax front. Retirement's completely different. You really have to figure it out yourself. You have to gather documents. If you have several types of accounts, there's several types of documents. So we're just going to look at a broad set of potential problems, some misunderstandings. We'll weave in some examples from the work that we've done with clients, some common pitfalls to help you at least understand the tax landscape a little bit clearer.
Yeah, this is going to be kind of retirement taxes 101. We're going to try to stay out of the weeds and keep this as simple as possible. We've talked about making the complex topics simple, so that's what we are going to attempt to do today.
Best of luck to us. So Aaron, what are the 3 main types of income when someone is retired?
So this is for
maybe even not even retired, right?
Yeah.
Like this applies to anyone.
Right. So this is for working and retirement, but we want to set out some of these kind of definitions and understanding to help lay the groundwork so that when we refer to these terms, that you kind of have an understanding. So the first type of income is earned income. This is money that is made in exchange for the work that you do. So this could be your salary, your wages, your tips. This is what most of us are kind of familiar with in the working years. Second form of income is unearned income. This involves money that is made without working, without getting up and doing something. So if you sat on the couch every single day for a year, you still received this income. You haven't put out any effort in order to receive this income. So that could be interest, dividends, rental income, Social Security, pension, et cetera, all falls under that unearned income section.
But earned income and unearned income are classified as ordinary income.
Yes. So that's kind of the top of the filter, the broad definitions. There's ordinary income and then everything else. And then when you drill down, unearned income and earned income fall under the ordinary income section. And then capital gains falls under kind of everything else. And this is where it gets complicated. It's clear as mud.
Yeah, so capital gains, there's a couple layers to it. One, it's for when you sell an asset for more than you paid for it. So if you've ever looked at your investment statement, and this is for a non-retirement account, so this only applies to a brokerage account, an after-tax account, a joint taxable account, a trust, money that goes in after tax that's invested. Okay, so let's say you bought Apple stock for $100, and a year later you sell it for $110. Okay, you paid $100, you sold it for $110. Your realized long-term capital gain is $10. Okay, let's say you sold Apple stock after 6 months. So you bought it for $100, you sold it at $105. That $5 gain would be classified as short-term capital gains. Okay, so capital gains can apply to a stock, a bond, a real estate position, a business, and it's essentially the difference between what you pay for an asset, called the cost basis, and what it's worth today. So you can realize a loss, you can realize a gain, and apply that to your current year taxes. Now, it gets a little nuanced because there's short-term and long-term capital gain. So a short-term capital gain would be my last example, selling something before 1 year. So the magic period is 1 year. Anything that you sell less than 1 year from purchase is a short-term capital gain or loss. Anything you sell after 1 year is a long-term capital gain or loss. And the difference is tax rates. So in general, short-term capital gains rates are going to be higher. That's not always the case, but that's mostly the case. Usually the case. And long-term capital gains rates are going to be lower. Usually. And
there's always a caveat and an asterisk to everything.
Yeah. So make sure that you know when you're selling something, is it a short-term capital gain? Is it a long-term capital gain? And understand the differences in tax rates.
So let's get into that. How are the tax rates handled between long-term and short-term?
Short-term gains are taxed at the same rate as your ordinary income rate or your income tax rate. So if my tax rate is 35%, let's say I have a really good year and make a bunch of money, my tax rate is 35%, and I realize short-term capital gains, I'm going to be paying 35% on those short-term capital gains because I sold that stock, that house before that 1 year mark. Long-term capital gains, let's say I make a lot of money. My income tax rate is still 35%, and I sell that stock or that house after a year. I'm married, so I'd be filing jointly. My long-term capital gains rate might be 15%, a much lower rate than my income tax rate of 35%. So depending on when you sell an asset, short-term versus long-term gains, long-term capital gains rate can be lower, especially if you're a high income earner.
So let's just talk about those first couple of years. You're looking forward to retirement, you're working, maybe you have 2 to 3 different forms of income. It's pretty easy to keep track of that, know how much is coming, you have an idea of what's going out. Once you flip over into retirement, that's when it gets a little bit confusing. We don't know exactly how much our income is going to be across all different sources, because oftentimes when you retire, it's an overnight switch. You go from maybe 2 to 3 forms of income to 5 to 7 or more different forms of income that you have coming in. So one, it's kind of a question mark of how much am I going to be paying in taxes? And 2, it's where is that income coming from? How does it all work together? So that's what we really want to get into today.
Yeah, so things So let's provide some examples on types of income and what classification that income would fall under. So what about a pension, Aaron?
That falls under unearned income.
Okay. What about a distribution from an IRA?
It falls under unearned income.
Okay.
But it's all under that ordinary income bracket.
So let's just say it's ordinary income.
It's ordinary income.
What about a part-time job?
That would be earned income.
Okay. But earned income plus unearned income, that would comprise your ordinary income, and that would help determine your income tax rate.
Mm-hmm. That's right.
Where it gets tricky, and a lot of people think that paying capital gains can affect your income tax rate. That is sometimes true. Okay. Again, it depends on that 1 year mark when you're selling an asset. So if I realize short-term capital gains, I'm going to be taxed at my income tax rate. If my income tax rate is really high, like 35%, then I'm going to pay those short-term capital gains rates at 35%. Okay. So there's no difference between earned income, my income tax rate, and short-term capital gains rate. It's all going to be the same because I sold that stock or house or business before that magical 1 year mark. So I realize short-term gains.
Mm-hmm. What's
different is if I wait after that 1 year mark, I'm going to qualify for a lower long-term capital gains rate. Now, let's say that I make $150,000 in taxable income. I'm filing single, and I realize $1 million in long-term capital gains. You might think realizing $1 million in long-term capital gains would affect my income tax rate on that $150,000.
Mm-hmm.
You would be wrong. Okay, so let's say my taxable income rate on the $150,000 is 20%. My long-term capital gains rate is still going to be 15%, although it's going to be on a much higher amount. It's going to be on $1 million times 15%. The 20% is going to be multiplied by the 150,000. Taken together, that's my taxes owed for that year.
Yeah.
So the message is, that's a lot of words. That's a lot of nonsense, you're probably thinking, but long-term capital gains will not cause your ordinary income tax rate to be higher.
Right. And there are pretty simple tax tables to help figure out what your long-term capital gains rate is going to be. It's either 0, 15, or 20%. It's pretty straightforward, and it is all just based on what your taxable income for the year is. So that's a pretty easy figure to determine. What is not so easy is what your income tax rate is for the year. And that's where a lot of retirees are tripped up.
Where people get confused on the long-term capital gains, how does that affect my taxes? That whole conundrum. I think they get confused on, while long-term capital gains doesn't affect your income tax rate, it could affect your adjusted gross income, which directly correlates to deductions and other benefits that you might receive, like Medicare, like lower healthcare premiums. Like, a lot of retirees before they turn 65 have to get private health insurance, and they go on Obamacare. Well, if you're realizing too much in capital gains, that could affect your adjusted gross income and affect those other benefits. So you need to be mindful about how all the pieces work together. And as Aaron said, this is all clear as mud.
Yeah, this is a pretty dry topic. It's not exciting, but it's something that just about everyone deals with at some point or another. So we want everyone to be armed with information as you enter that next season of life. So in a more practical conversation, let's just talk about choosing which investment accounts to pull from. So when we put together a financial plan, we look at all of the income coming in, we look at all of the expenses, that's your money going out, and we see if there is a gap that needs to be filled. And that is typically filled with retirement savings, retirement investment accounts. So there is a tax-friendly way to go about liquidating these different accounts month to month, annually, so on and so forth. So let's talk about liquidation priority.
Yeah, so let's roll through a quick example. Let's say you have income coming from a pension of $50,000 a year, and let's just keep it simple. $50,000 a year in pension income. Your expenses are $80,000 a year. Okay. A lot of retirees want to know where that gap is going to come from. And let's say you have a joint taxable account with your spouse, you have an IRA, you have a Roth account. Okay, so that $30,000, your 50,000 in income, 80,000 in expenses. There's a shortfall of 30,000. Where does that come from? What's the most tax efficient way to pull that money out? And this is going to be a little different for each person, but in general, it's going to be most tax efficient coming out of the joint taxable account, the after-tax money, because again, we can manage capital gains. We can manage short-term capital gains. We can manage long-term capital gains. And what I mean by manage is if you need $30,000 a year out of that portfolio, and I sell $30,000 worth of stocks and bonds, if I sell something at a gain, I can sell something at a loss to wash that away, to wash that gain away. So in theory, if I'm doing my job correctly, I can send out your 30,000 without triggering a taxable event. Okay. Opposed to an IRA, all that money goes in pre-tax. It grows tax deferred. You haven't paid any taxes on it. And Uncle Sam wants their cut. Every dollar that you take out of that IRA is going to be taxable at your income tax rate. Okay. I can't control that. I can't do anything to offset that. I can't sell something at a loss to wash that gain away. It simply is what you take out multiplied by your income tax rate. And then the Roth, lastly, some people say, okay, Nick, I've got this Roth. Anything I pull out is tax-free. Well, that's true. And in some circumstances, if you're getting close to a threshold where if you take $1 more out of your traditional IRA, that'll take away your Obamacare or some other deduction or benefit, then it might make sense to take money out of the Roth if that's your only option. But in general, you want that Roth, that pot of money, which will forever be tax-free when you take it out. You want that to stay invested. You want that to grow for as long as possible. So let's use an extreme example. Let's say I have 100,000 in a Roth, right? And I'm 55 and retire, and I'm expected to live until 80. That's 25 years of compounded growth, assuming that's invested in an aggressive manner, which it should be, again, in general. You want that to compound. You want it to grow. 100,000 invested over 25 years, compounding at 8% might be 700,000. You've taken that 100,000 in tax-free money and turned it into 700,000 in tax-free money. And I'm just throwing figures out there. Like, I don't know what the math is on that. That is extremely powerful.
So the area that people run into, and this is a recent example that we have witnessed in real time, is trying to manage these different accounts and the benefits that you may derive from using one account over another. So we have an example of a client who has been taking from their taxable account since they retired because they are just kind of going through the order of operations. And that's been great because they have kept their income under a certain threshold in order to obtain some financial assistance. Now their taxable account is running pretty low. It's going to be exhausted in the next several months or a year. So their next option is to pull from their IRA because that's what is left. If they continue distributing from their IRA at the same rate that they did their taxable account, their taxable income is now going to be much higher than what it was, and they are running dangerously close to the threshold where they will not receive that financial assistance anymore. So while this is a good rule of thumb, it's not always the best for every single person. So you have to look at every facet of your life to see, like we talked about, your Social Security and your Medicare, different thresholds, how they all work together, because again, it's going to be different for everyone and what your income needs are and what you need to keep them under.
That's a good example. And in this case, I think on paper, the plan really worked. Like taking funds out of the taxable account did make the most sense from a tax standpoint. Where this client ran into trouble is they were spending 3 times the amount that we had modeled in the financial plan. So it really threw our cash flow estimates, our tax estimates for the next couple of years out of whack. So that's just a good reminder to make sure that your distribution rates, your actual rates that you're taking out of your portfolios mirror what you're modeling in your financial plan, because sometimes those can be glossed over, or you're spending more and you're thinking you're spending X, but you're actually spending Y. That really happens all the time. Mm-hmm. So that's why for pure clients, we're always obsessing about expenses and the inputs to our financial planning assumptions because we want those to reflect what's actually happening.
Yeah. So it's just important to look at everything. We talk about financial planning data points kind of as levers that if you pull one, it's going to affect another. So make sure that you look at everything all together, and your income in retirement is no exception to that.
So lastly, we're going to walk through ways in which we help clients reduce and mitigate their taxes. Of course, we're not CPAs, so it's not like we're diving into their 1099s and all that stuff. But there's several reoccurring tax leaks that we see, especially from newer clients as we tighten up their house. The first one is, and this is really easy too, so a lot of these are the low-hanging fruit, as we call them. The first one is, as you work for 30 years, you're working for probably multiple companies, you've maybe worked with several advisors, and you have accounts scattered everywhere. It's not uncommon for us to onboard a new client and find 9 different accounts. Maybe 2 or 3 of them are the same type of account. So instead of one IRA, they have 5 IRAs. Instead of one Roth IRA, they have 3 Roth IRAs. So make sure that you're combining like accounts under one roof, because once it's time to file your taxes, it's going to make your life easier. It's going to make your CPA's life much easier.
Yeah, the next one is, we talked about Roth conversions in pretty good detail, I think 2 episodes back. So that's a good one if you haven't listened to that one yet. But the Roth conversion question is one that we often get. There's a lot of articles and information about it. And in theory, it's a really great tool to use, but it's not for everyone. So we find that if you are going to do a Roth conversion, typically it is best to stagger it out. So that might look like, if you want to take $100,000 out of your IRA and convert it into a Roth, rather than doing that $100,000 all at once, and again, adding that to your taxable income for the year, maybe stagger it out over 4 or 5 years. So that might be $20,000 a year, $25,000 a year, so that you're not adding $100,000 to your taxable income all at once. It's just an extra 20 to 25. So that could potentially save you on taxes if it doesn't need to all be done at once.
Okay, the third one, given where we're at in 2022, stocks and bonds have gone down together the first part of the year. I'm noticing a lot of marketing, several new clients that we've onboarded in the last month having exotic alternative investments. And Wall Street is really pushing these as a risk reducer, as a diversifier from stocks and bonds. And I'm not going to get into that because it's a whole different topic and I'll go off the rails. But know that if you buy a limited partnership, if you invest in a hedge fund, if you invest in a private equity fund, if you invest in a structured note, like some of these exotic holdings can trigger a K1, which, for those of you that don't know what a K1 is, it basically makes your taxes a nightmare. You're almost guaranteed to file an extension. You're waiting. Your CPA is probably going to charge more because it makes everything much more complex. So just understand what you're getting into. And if you are getting pushed some of these exotic securities, know that, one, the person pushing them is probably going to benefit in some way by selling you this. But 2, what they don't talk about is all these tax headaches that you're going to be saddled with. So I've dealt with these. Once you buy them, they're super hard to unwind. So just understand what you're getting into.
The fourth one is, in the spirit of simplifying your retirement and financial life, is not making things unnecessarily complex. There's a lot of people who, like Roth conversions, are just hung up on this one certain thing that they heard their friend is doing, or they saw it on CNBC or an article in the newspaper. It's really easy to get bogged down by these kind of flashy headlines of things that, quote unquote, you need to do, or it's the right thing. So make sure that you just find a good CPA or estate planning attorney or advisor, or whatever the niche is that you're trying to fill. Tell them what you want to do, find a good professional, and then let them do the work.
Yeah, and I think that's a really good point. And I would piggyback on that, is a lot of these decisions, whether they're tax or conversion or estate planning, people tend to make them in a silo. And we've said this before, it's like you need to understand how a decision affects the rest of your plan. Like you can't just go and do things in a silo, which is another reason to consolidate like accounts, just to make sure that you're understanding the full picture. So when we're modeling some of these decisions, like the Roth conversion, we're doing it in the context of your income, your expenses, your tax rates, your investable assets, your life expectancy, how you want your assets to flow. So it's not just this singular one-off decision. It's made in the context of your entire plan. The last one, and I run into this all the time. You're probably, if you've heard me speak, I talk about this a lot. And it doesn't matter if you're a do-it-yourself investor. It doesn't matter if you're working with another advisor. I would say more than 75% of the new formerly advisor managed clients. So an account that we would take on, a client that we would take on that was working with another advisor, over 75% of the time, they are just leaking taxes, paying more taxes than they need to. And this comes into play in a taxable account. Okay, so a non-retirement account, money that's invested with after-tax dollars, they're paying taxes every single year without doing anything. I just met with this doctor who is a high-income earner, works with a big Wall Street firm, and he told me he's paying $100,000, like over $100,000 a year from this one investment account, and he can't figure out why. So the biggest culprits are mutual funds in a taxable account. It doesn't matter if they're index funds. It doesn't matter if they're actively managed funds. It doesn't matter if they're low cost funds or high cost funds. Mutual funds in a taxable account can be hugely tax inefficient. Dividends is another one. Dividends are hardly the worst sin. If you're going to own dividend centric strategies, don't own them in a after tax account, a taxable account. The last one is kind of the same vein, taxable bonds. So corporate bonds, treasury bonds, all of those spin out taxable interest payments. So between mutual funds, dividends, taxable interest payments, and you can have a mutual fund that pays dividends. You can have a mutual fund that owns taxable bonds that's paying out taxable interest. So a lot of these can be intertwined, but they all add up to a tax nightmare. It's like punting on third down. You're just lighting money on fire. So don't do that because investing is hard enough.
So here's one argument that I will likely cut out of the podcast, but you said not to own like highly dividend paying stocks in an investable account. But on the flip side, high dividend paying stocks are not typically ones that you would see a lot of growth out of. So then you would kind of cut down on the capital gain side of things.
Yeah, but like you can manage that. I mean, you can manage if something is a high flyer by selling other positions at a loss. So,
right.
I mean, like we're looking at this problem, like we're taking a picture, we're saying this pays out a 6% yield. That's great, but after tax, it might be a 4% yield. It might be a dog crap company.
Yeah.
It's just if you're going to own, like if you have the option and you like dividend paying stocks, own them in your IRA, own them in your Roth. That's a great way to own them. That's a great strategy. It stood the test of time. Try not to own them in a taxable account.
Okay, let's plug our friends over at Opsal Dawson.
Yeah, so we really try to create intentional partnerships. You know, there's a lot of advisors, there's a lot of estate planning attorneys, a lot of CPAs, a lot of mortgage people that try to network and talk to everybody. And what they really want is for people to refer them business, right? There's a lot of takers in our business. So we said the hell with that. That doesn't work. We want to set up intentional partnerships, maybe one or two different firms. So we've set up a partnership with a CPA firm. They're the largest CPA firm in Clark County, Opsal Dawson. They do my personal taxes. We've got them in front of several clients. The feedback has been great. So if you need a CPA just to do your taxes, they're great at that. For people with complex problems like selling a business, they have stock options, selling a real estate position, anything that's more complex or graduate level, we have a partnership where Pure will actually pay the fee to get you in front of a senior Opsal Dawson tax accountant. And they will give you advice. So they would not be doing your taxes. They would be giving you actionable advice based on your circumstances to help you mitigate or reduce taxes.
Yeah, it's been a great program. Like you said, clients have given us great feedback on it. They found a lot of value. And typically just a few short hours, you kind of give them information based on what you want to do, and they will give you professional, credentialed advice surrounding your personal situation. So it's been very helpful.
Well, and who doesn't like to save money on taxes? I mean, that's retirees, one of their favorite things to do. Talk about recessions, talk about what's going on in the stock market, and save money on taxes.
It's a great deal. Thanks for listening to this episode of Blind Spots. We will see you in the next one.